Hello, everyone. I'm glad you're with us today. I just wanted to say welcome to day two and to introduce our first speaker. A few housekeeping things as you start your day. Don't forget there's polling questions along the way, and you can jump in and out of sessions at any time, as well as record or watch any of the sessions that you couldn't catch today live because there's so many great sessions and it's hard to choose. So with that, I'm going to just straight introduce our first speaker of the day, Jason Bradley with the FRC, the Financial Reporting Council. Jason's role at the FRC is a project director involving developing the audit assurance and ethical standards that are fit for purpose to reflect the current public interest. He focuses on the use of technology by auditors and chairs the FRC's technical and digital steering group and the external working group. He's also a member of the IASBA Technology Experts Group, and he comes from a very varied career, having time spent at Deloitte, Kaplan, and the ICAEW. Thank you so much for joining us, Jason, and please take it away.
No problem. Thank you, Danielle. Thank you everyone for attending today. I'm going to be talking about a subject that we've been thinking about quite a lot at the FRC, which led to a specific publication we made last year, and it's about addressing exceptions in the use of audit data analytics. It's a really interesting topic, and it's one that we've had some experience of from a kind of practical inspections point of view, as well as a technical point of view. So I think we've been able to develop some quite unique guidance based on what we've learned from inspections over the course of the last few years. So essentially what I'm going to do, I'm going to talk you through essentially why this guidance exists in the first instance and what the kind of background to it was. And then I'm going to talk you through some of the key things that we've laid out in thinking about just one way that auditors could think about exceptions when they're using audit data analytics. So it's not as though this is the only possible way it could be thought about. There's certainly other approaches that audit firms use and other approaches that different assurance providers use. But essentially, we thought it was worth thinking about putting out some general principles and guidelines to really start to address some questions around, particularly, what happens if I'm doing an audit data analytic and I get thousands of exceptions? What's the best way that I can respond to that as an auditor, so that I'm not devoting huge amounts of time to looking at lots and lots and lots of exceptions that might not actually be exceptions. They might just be problems I've had, for example, in defining the initial parameters of my analytic. Before I do that, I'm going to very quickly talk about who we are at the FRC. So we are the UK's independent regulator responsible for promoting transparency and integrity in business. We set the UK corporate governance and stewardship codes, and we also set the accounting, actuarial, and audit standards. We produce the guidance that sits around that as well. We monitor and take action to promote quality of corporate reporting, as well as audit and actuarial work. And we are also operating the independent enforcement arrangements for accountants and actuaries. The key thing we do in relation to audit really is that we're the competent authority for audit, which from a kind of UK legal sense essentially means we are the ones that have the authority to set that auditing and ethical standards and to do the ongoing monitoring in respect of that. Daniel's briefly mentioned who I am. So I work within our audit insurance policy team. So my day job is really developing standards, but I also have a big hand in how the FRC thinks about technology. So as Danielle mentioned, I chair our technology and digital steering group that's responsible for thinking about the FRC's strategy when it comes to technology and its use in assurance engagements. So not just necessarily in traditional audit, and I cover all sorts of things from the use of audit data analytics to the use of machine learning and the use of any kinds of tool that is perhaps pushing the envelope a little bit in terms of innovation and thinking about new ways of considering how audit can work in a world which is increasingly about large amounts of data and doing analysis in a different way, a way that we wouldn't have been able to do 5-10 years ago when we were looking at putting together audit files. Thinking then about the guidance that I'm here to talk about today is really to consider why this guidance actually exists. I take you back a little bit in time to 2020/2021. We put out a consultation called Technological Resources Using Technology to Enhance Audit Quality. And the object of that was to respond to really challenges that a lot of auditors have brought up to us informally. And one of the things that was highlighted was that a substantial challenge for auditors was what they're supposed to do when they get a large number of outliers generated in audit data analytics. Most of the people responding to it were fairly happy that in a lot of instances, if they applied data analytics tools to a population and they got a vast number of exceptions, that in most instances, it was probably actually a problem with their initial tool and how they'd set the parameters for that, rather than there being, tens and tens of thousands of errors in every population. Now, of course, it's conceivable there are that many errors, but in most instances, a lot of what auditors said were, well, what we feel like is when we do these analytical tools and we generate these, really, it's because maybe we've not quite understood the business correctly, or we haven't quite understood this business cycle. The problem that they were encountering then is how they dealt with and documented those exceptions in an audit file, because there was a feeling in the profession, in the UK at least, and certainly from some international people we've spoke to, that they would have to look at every single one of those exceptions and understand why it was an exception and what happened. And they were very, very uncomfortable with sampling those exceptions or stratifying those exceptions. And a lot of auditors were equally uncomfortable in some instances at going back and saying, well, actually, we've generated all these exceptions because we haven't thought about this parameter, or we set this one too broadly. So auditors are very uncomfortable with going back and really kind of saying, well, we've learned from that initial run of the tool, let's run it again now with some of the parameters adjusted. What that led to in a practical sense, and we saw this in quite a few inspections, is people spending huge volumes of time looking at exceptions, which might not have even really been exceptions. They weren't truly a problem with the population. They were an issue with how the tool had been done. The knock-on effect for quality was then people were spending so long in some instances on looking at these exceptions that it was taking time away from them looking at areas that are highly judgmental. So for thinking about, auditing accounting estimates under ISO 540 or the equivalent international or national auditing standard, things that are really judgmental, that really needed the auditor's time for them to sit down, really get to grips with what an entity had done and how it's presented in the accounts. So what we felt is that it was beneficial for us as an audit regulator to sit down and say, well, we actually think that there's a possible way you could think about exceptions that's more effective, more efficient, and ultimately, the thing we're most interested in from a regulatory perspective, a little bit better for quality, because it allows auditors to use their time where their professional experience is better deployed, rather than searching through thousands and thousands of exceptions. So in that publication, essentially what we said is that we will develop some guidance with the profession. So we worked with some of the largest audit firms and some smaller firms and all kinds of different stakeholders to think about laying out some general principles for dealing with outliers. Now you'll notice there I've switched from using the word exception to the word outliers when using audit data analytics. Part of the reason for that is that the word exception has a slightly loaded term from an ISA's perspective, because when you think about exceptions in an audit, you think about having to look at all of them. And that makes sense in the context of how exceptions are thought about in other areas of the standard. But it created a problem with this. And that's kind of where the idea that every exception had to be looked at individually was originating from. So what we did is we slightly altered terminology, and we said, well, what we've done is said, if you do an initial scoping run of your tool and you generate a large number of outliers, the question you ask yourself is, of that group of outliers, which of them are true exceptions, are really problems, and which of them are just as a result of scoping problems? And so that was a large part of what we really tried to think about, is doing a little bit of a language shift, which I think helped a lot of auditors understand that going back and thinking about how effective a tool's set of parameters is actually really sensible, works in the context of the standards, and allows the auditors to think a little bit more clearly about the best way of thinking about dealing with actual exceptions. We laid out a potential approach, and we included an illustrative example, which I'm going to talk you through a little bit later. And we also included some best practice for when we're refining exceptions. And in order to do that, we really looked at real-world examples observed by our audit quality review team. We looked at talking to specialists. We looked at people that deal with data analytics. And we looked at issues that are described to us by the auditors from external engagement. What it's allowed us to do then is build a piece of guidance that's reflective of current practice. So we also wanted to be very aware as auditors, as a regulator, that we didn't want to just put out a piece of guidance that was entirely focused just on the regulatory aims without thinking about how it would work in practice. So we then included, I'd say, lots of best practice material in there to really try to get an idea of what's going to be genuinely helpful to people when they're looking to use these tools. So one of the first questions we sought to answer was, what are some key principles that we think are sensible? And the first step then for us was to say, before we even get to thinking about how we can deal with large volumes of exceptions, it's important to lay out some key principles for when it is actually suitable to use audit data analytics or a similar tool in responding to identified risk. So we looked at some general principles that are a relatively high level, but the idea is to get auditors to think carefully about, when they're using audit data analytics, is it appropriate to the population that I'm looking at, before we even get to thinking about refining it. So the 4 bullet points, I'm going to talk a little bit about each one and some of the key kind of things that we thought about. So the first one is, if the use of the audit data analytics isn't mandated by a firm's methodology, whether it's actually going to be the most effective method for collecting evidence. So some firms at the moment are mandating the use of data analytics in testing certain areas, which from a methodological perspective is fine, but the question still needs to be asked about whether it's always suitable. So is it actually the most effective way of collecting evidence? In many instances, it certainly will be. But we've definitely seen cases in inspections as well, where using the audit data analytics tools often generated substantial extra things to think about that might not actually really have been high risk areas or indicative of material misstatements. So there is still a question that I think everyone really needs to ask themselves. It's easy as someone who's very interested in technology to be a little bit personally biased towards the kind of use of tools. But I think it's still an important question to ask at the outset of anything is well, is the tool I'm going to use the actual best way of doing it? Even if it's been mandated by the firm's methodology, does it make sense in this context? Do I need to rebut that presumption that it should be used always? The real big one, and I think the one that most helps with really trying to think about refining parameters, is if the auditor's understanding of the entity and its environment, how transactions are recorded, etc., and how balances relate to each other, is it sufficient to allow for effective use of analytics? So even if you think the tool itself is going to be particularly helpful, is it actually going to work based on your understanding? So do you know enough about the firm, about the company you're auditing, to make it work? Do you understand the entity and environment properly in a level of detail that's sufficient for you to make effective use of audit data analytics? And again, that's really an important part of the question. Do you understand the data flows within the entity, how the data is managed, how it's stored? All of those things are going to really help with building expectations and thinking about where it's going to be appropriate to deploy those tools. It's easy in some sense to say, well, I can see how this analytics is going to be really useful for this population. But you've got to really understand how that population links into the rest of the financial statements, how it works in different ways, and how really your own understanding as an auditor can help you develop robust expectations that analytics can help you with testing. The big question, and I think the most important one, and it's not just something I'd be speaking about here, any tool, any process that we look at now with an audit, one of the questions is always, is the data of sufficient quality to support meaningful analysis? You could run a data analytic on any population irrespective of quality, but the question is whether the output is truly meaningful. If you start out with very poor quality data, it doesn't really matter how good your tool is, you're going to get poor quality results from it. And so one of the things that we've really asked audit firms to think about, and one of the key principles underlying this guidance, is whether or not the data is actually good enough. Is it complete? Is it accurate? Is it valid? Is it accessible in a way that you can actually facilitate, that it facilitates sensible analysis? And this is still one of the big issues with a lot of data analytics, and a lot of work going into making data look good enough, have a nice enough format, and work in a way which makes it suitable for the use of analytics. Which brings us really to the final kind of key principle, which is thinking about data cleansing or other processes that people might undertake prior to using a data analytic. So taking information straight from the company and then going through it, cleaning that data up, making it suitable for use with an analytic. And this is where we've kind of had an ongoing debate, and I think it's one that's going to go on for a little while, is what is a kind of reasonable level of cleansing of data, and what is, in some ways, building a data set out in a way perhaps that isn't representative of the original data. So when undertaking those data cleansing processes, something we talked about is that the auditor should really be mindful of the processing. So it should be sufficient for its subsequent use, but not so extensive that it undermines the objective of the audit procedure in the first instance. We've seen instances where people have cleansed their data so much that they run an analytic on it and there are no exceptions. But the reason is because the data has been so heavily modified in that process, it becomes difficult to see how you would actually be able to link that back to potential issues of material misstatement in the financial statements. So whilst we've said, we totally understand the need to think about how data is cleansed, that really it needs a careful consideration as to how that cleansing process, be that something the firm does or be that something they do through third-party extraction tools, really need to think carefully about the extent of that processing of the data and where it does or doesn't undermine the potential analysis that comes out of it. Quick little side one we did note as well is that there might be instances where the overall quality of the data isn't necessarily amazing, but there might be subsets of it which are useful. So the classic one we got from a few auditors were, well, the firm, the client we're auditing switched data storage systems, for example, halfway through the year. First half of the year, data's great. Second half of the year, data's terrible. Does that mean we can't use analytics at all because the overall population is dreadful? Or actually, could we use it on a subset of that where the data is of sufficient quality? And then think about, really considering whether the second set of data might be more appropriately analyzed in a different way. So it was an interesting set of questions to really think about how that data is sort of is looked at and cleansed and thought about. And yeah, it's an interesting set of questions, and I think one that we're still really working with and thinking about how auditors can get to a place where they can be satisfied that they've done enough without doing too much, if that makes sense. One of the next bits I'm going to talk you through then is what our general model looks like. So what I've got here is a visual representation, which hopefully everyone can see on their screen. If not, I believe a PDF of slides is available. So this is our general approach for what we think is one of the many ways that you could think about addressing exceptions. And really, we wanted to try to present this visually because in some sense, people appreciate seeing things visually sometimes. Sometimes people are very visual and it works better for them in that instance. And the other instance, it's kind of, I think from our perspective as a regulator, easier to kind of understand the flow if we've actually laid it out in a way which works. So we always start off by setting some kind of population expectation. So, we expect all debits in this to match to a credit in these accounts, or we expect these kinds of transactions to always match with these other kinds of transactions. It can be all kinds of different sets of expectations that we're setting out within a tool. What we then said is, well, that first run of the data through your tool, you could just refer to it as initial application. So you do an initial application of that automated tool or technique, and you think about whether or not the data you've put in matches that set of expectations. Does every debit in that match to a credit in a different thing, or is there a problem? So what we said is, well, really, that initial application of the automated tools or technique is really kind of important. And it's as much of a scoping tool as anything else, because what it's designed to really say is, well, does that match your expectation? So what we might say as auditors is we think that based on our understanding of the entity, previous error rates and things like that, we'd expect there to be a relatively small volume of exceptions, because we know from the data flows that everything should match, or these things should be, dual posted to these two different ledgers. So we might end up with a result that matches that expectation. Most things work, they work, the patterns look sensible, they look as though we expected them to look based on our understanding of the entity, and there are some exceptions. What we were seeing, and as I mentioned, is kind of the main driver for why this guidance exists, is where the results don't really match the expectation. So perhaps you've put things in, and what you've generated is a vast, vast number of exceptions. So we saw one where upwards of 50% of the transactions didn't fit in with the auditor's initial scoping exercise. So the question then becomes, well, does that result indicate either that there is a way bigger problem with this client than we thought there was, there are more errors here than we possibly could have imagined, which we must always accept as a possibility, or in a lot of instances, actually, the other question might be, well, does that just mean those parameters, that expectation we set initially, wasn't appropriately defined? Did we miss out something? Is our understanding of the entity not as good as we thought it was? Or has there been something that's changed that we don't necessarily pick up in our initial expectation? So what we really laid out here in this box, which we call the refinement process, is this idea that it is okay from an auditing standards perspective to recalibrate that tool and do it again. So actually what you might see is, I identified this problem, but actually a lot of those exceptions are because we didn't set the parameters correctly. So let's go back, reparameterize our tool and run it again. So this kind of loop is what we built in to the model, really, to say it's okay to think about whether your parameters were fine and go back and adjust them. A result of that might be that, in fact, the number of exceptions does come down to a level that's more representative of your understanding of the population, or you might need to refine it again. We also talked about, is there a certain number of refinements where, if you've refined it 7 or 8 times, does that just mean there's a problem? And that's really a matter, I think, there for professional judgment, is to say, well, the objective of this is to not refine away where there is a problem. And so what we've said to auditors, and what we talk about a little bit in the subsequent refinement steps, is you really have to think about where there is a true issue. And the objective of this refinement process is to not just bring down the number of exceptions because we haven't got time to deal with them, or because we don't really think there's a problem. It's to really try to help auditors think about those parameters. The other key bit for us then was that once you've kind of gone through this refinement process and got to a place where you're happy that the exceptions generated are real problems, there is an issue with the data somewhere, things don't work because of some reason that we need, could as of yet be a material issue in the financial statements, do we have to test all of them? So let's say we have, 300 exceptions from a vast population. We brought it down hugely by really thinking about our parameters, but do we need to test all 300 of them? And that's where we started to put in some extra guidance on saying, well, not necessarily, because those 300 exceptions might be, in some senses, homogeneous. So they might all be caused by the same issue. Some percentage of them might be caused by the same issue. So what we're really saying is, if you've got something like, let's say, 300 exceptions, it is reasonable to sample those where there are commonalities. So it might be that 100 of those 300 are all caused by this kind of system error, or some kind of issue with an individual who wasn't sure what they were doing when they did a posting. Well, if you look at 20 of that 100, you're going to probably find everything you need to know to explain that story and think about how it impacts the financial statements. Testing all 100 of something that's caused by the same root cause probably doesn't add a great deal to the understanding. So this was the other big bit that we really did, where we tried to think about saying, well, in some instances, even when you've refined down that process and you've got to a place where the number of exceptions seem sensible, you also then don't have to look at every single one of those. And in many instances, sampling the exceptions can tell you what the core issue is and the potential impact on the population without having to test every single one of them. And again, I'll just sort of remind everyone of the reason that we were thinking about this is because the idea was to get people to a place where they felt comfortable enough doing these things. And that pushed Audit time towards thinking about things that were really problematic, really judgmental, and that really needed professional accountants' years of experience to deal with, rather than trawling through hundreds and hundreds of thousands of exceptions. This is all available on our website as well, by the way, as a kind of PDF set of guidance, which, so if you just go to the FRC's website in the UK, it's underneath our staff guidance notes. So this is all available if you wanted to look at it at a later date. That's our kind of general model then. What we then thought about is, well, this refinement process, do we need to say a little bit more about that? Because is it a little bit open to just say, yeah, you can refine your parameters? So what we thought is it's probably sensible for us to think very carefully about some kind of general guidance on, if you've done an initial run of your analytical tool, and you've generated a vast number of exceptions, what are some general principles, both good and bad, when it comes to thinking about refining that analytic? The first most obvious one we laid out there is it's not appropriate to adjust parameters to artificially reduce the volume of work required, because in that instance, it's going to lead to auditors not obtaining sufficient and appropriate audit evidence. The key place we've seen that is where people didn't necessarily have the resource available in the audit that they thought they might have. And so what they've really done when they've got a lot of exceptions is said, we don't have time to deal with this, let's get the volume down. And that's not going to be something that we think is reasonable as an approach. If there are that many exceptions and there is truly a problem, that problem needs to be addressed rather than refined away. So that's really what we're trying to get at there, which is messing around with the parameters to just get the pure number of them down, even when there's not really an indicator that that's appropriate, is going to lead to problems from an evidence perspective. A common one that we saw was people wondering whether they could adjust it to try to generate roughly the same number of outliers as in the prior period. The understanding of the entity from the previous period will help in developing expectations, but any assessment of potential outliers should be based on the current period. So it helps with saying, if you only had 50 exceptions last year and all of a sudden you've got 5,000, it's not about saying, well, I need to get that 5,000 down to 50 because that's what we had last year. But you're still using last year's knowledge to think, well, 5,000 is a vast increase in the number of exceptions. Maybe there is something to think about here. A big one was thinking about reducing the number of exceptions when the data is known to be of poor quality. If people have put poor quality data in, as we've mentioned before, you often get poor quality results. And so we said that where your data is not of a very good quality, going in and thinking about it and really trying to, deal with that data issue by addressing parameters later isn't really the right way. In that case, poor quality data needs to be addressed before the audit data analytic is applied, because that's the factor there. Better quality data going into the analytic is going to lead to a better outcome. So we were very, very clear that we thought that doing too much to it post hoc and saying, well, we've got lots of problems, but we know the data was bad, let's adjust it around, is not really the approach that we think works from a kind of standards perspective. It's about asking those quality questions beforehand. They were some of the things that we thought people shouldn't do. But I guess, one of the key questions that we've then had is, well, what should people do? And I guess the first one is to be very careful about analyzing the outliers to see which of them are likely to be true exceptions that are warranting investigation. A really important one is discussion with management, in a similar fashion to how you would refine an exception when you were looking at analytical procedures. So from the UK's perspective, our standard on analytical procedures is IC UK 520, which is based on the IAASB standard. And in that, it talks about, well, if you've tried to build an expectation and it doesn't work, you need to go and talk to management and understand it. The reason that we have that in is because in some instances, we'd seen cases of people getting very into the data and very into the tool and spending a lot of time working on the tool and working on the data, but never really talking to the client about where the issues might be or what the issues indicated. So it was very, very interesting because it sort of was saying to people, even when you're using these tools, please still go out and speak to management, still get an understanding of the entity, still think about how it all comes together, and make sure that that conversation really is important. It's important to understand from management how the entity works. Finally, then the last kind of thing we think is sensible. It kind of relates to this last point on the kind of don'ts section, which is re-examining the underlying data. So if a full understanding of the entity flows and the data flows wasn't possible beforehand, maybe the data was, particularly unusual or the structure of it was strange, it might be reasonable to go back and say, well, now we've actually done that analytic, we understand the data better. So it almost kind of feeds back into the understanding of the entity, its environment. And then that we thought is also a completely reasonable kind of cycle. Say, we thought we had a good understanding. Clearly, we've misunderstood something. It's reasonable for us to go back and really think about how that feeds back into our overall analytic. So again, these are not rules. This kind of guidance that we're putting out here in this formula, which I think relates to one of the questions that saw pop up, but we'll deal with that on the question slide. So this kind of guidance is non-authoritative, so people don't have to do it like this, partly because there are many ways to do exceptions. But these set out kind of guidelines, principles, general ideas that we think are sensible. And all of these general parameters work with different ways of thinking about addressing exceptions, not just the model that we've talked about. So that's one thing we tried to do, is to get these kind of general ideas and these principles around defining parameters to be general enough that they were useful across a wide range of different analytics. The final thing I'm going to talk about then, before I come to looking at some of the questions that we've got, is to just talk you through an example of a way of using this analytics. So this is something we include within the guidance itself. So this is the kind of last little bit I'm going to talk about before I come to the questions. So we used a real life example that we've seen some firms use. It's a relatively simple analytic. We've certainly seen people use substantially more sophisticated ones, but we wanted to use a relatively simple one, primarily because then we could talk more about the general principles and present really a situation that people can apply those, where people can take those principles and apply them to their more complex scenarios. So one thing that we said was, well, what's a kind of classic one? And this is something that we've seen people use, and it's a relatively simple one, but it helps to try to find and analyze revenue flows. So the expectation that was set was that credits in revenue should correspond to a debit in the debtors ledger or cash in transaction posting analysis. So where there's a list of everything that's posted into revenue, in most instances, when there is a credit in revenue, there should be a debit to the debtors ledger or cash. So that's a reasonable expectation the auditor might have based on their understanding of the environment. They then run their analytic and see whether or not that is true. There are two options, really. It could be that results match expectations and there's a few unusual transactions, but for the most part, all the credits do match it. What we saw there is that in one instance, that had happened, but there were a vast number of exceptions where there were loads of credits to revenue and no corresponding debits to the expected account codes. So they ended up in a results do not match issue. What it actually turned out the problem was is they'd set the perimeters incorrectly initially, because items paid for with gift cards were included as exceptions because they were debited to a different place. So they weren't debited to debtors ledger or cash, they were debited to a different subledger. And the result was that they all showed up as problems to investigate further. Whereas in reality, people using gift cards to pay for things is a perfectly normal thing in a retail business. And so as a result, what the auditor thought about was, well, I don't need to test a sample of every single gift card because it's perfectly reasonable to say that people would pay with gift cards. So what I will do instead is I will go back up and I will reapply my audit data analytic, but I'll add in an additional parameter, which says, well, when there's a credit in revenue, it should correspond to a debit in debtors, a debit in cash, or a debit to the gift card ledger in this instance, because that makes sense. That is, from a business cycle perspective, completely logical. Reapply that and then look at the results again. Once we've got that result, go through, are the exceptions homogeneous? No. They look like some are caused by one issue, some are caused by another one. Or can I stratify my population? Can I think about ISA 530, so audit sampling in the UK standard? Can I stratify that and sample test some of them? So it looks like, of my 100 exceptions, 50 of them are probably caused by something like this, 50 are probably caused by a system error of this particular issue. So I can really try to stratify those up and look at issues. Then I can test what I need to get myself satisfied that I can conclude, and then I can evaluate the results of that, conclude ultimately that I'm fine with revenue from that perspective. So really this was just something we tried to build in to make it come to life. Because in some instances, I've definitely found with lots of tools and techniques, and with, as I've thought about technologies used more in audit, sometimes the easiest way to think about how it comes together is to actually just think about a practical example. What actually is happening? How can we kind of present that? And think about how we can show it in a way that is widely understandable. So that was the kind of example that we used to do it. Ultimately, then, that was the kind of approach as well as the intended outcome really for our addressing exceptions guidance, was to think about practical issues that we'd seen in inspections or that we'd heard from auditors. As a regulator, what do we think is an appropriate thing to do, or one of many different appropriate things to do? And something we always ask ourselves as a regulator is it something we should comment on? Is there value in us saying something? And we definitely thought there was here. Primarily because there was a specific concern amongst auditors that the way the standards worked were preventing them doing that kind of reanalysis, that reparameterization. And so that's why we developed it, as we said, and this is the kind of process that we went through. As I said, this is available on our website as well, and my email address and contacts are up with that if anyone has any questions or wants to discuss anything further in that. With that in mind, though, that's really the end of my talking bit. I guess the next bit for the rest of the session is if anyone's got any specific questions. I saw a couple pop up in the chat, so let's have a look at those and then see if we've got any more. So the first question was, tweaking in terminology was mentioned. Is this done at a standards level? So interesting question about doing that. So because the guidance that we produced is non-authoritative, we haven't tweaked the actual standards themselves. And really there's two reasons for that. The first is that there is a drive to make sure that the standards are, to as much a degree as possible, technology agnostic. So they talk about the use of technology, but they don't mandate the use of technology. And as a result of that, the definitions kind of have to work a little bit more broadly. So exceptions means what it means from an ISA's perspective. And what we've really done is, instead of tweaking the definitions themselves, is to get people to think a little bit differently about exceptions versus outliers. So we use outliers in this guidance to describe things that look like a problem, but need a bit more investigation before they become an exception. That also kind of works, well, it works from the perspective of other guidance that uses similar terminologies. It's a good question, but no, we haven't changed anything at the standard level. Next question. So any data manipulation is done using certain assumptions which can in turn impact the outcome of the analytic and the contents. Very true. And I think that that's really something that's still ongoing. And it's a question where maybe we might think about more guidance in the future, which is that data manipulation will change the data in some way, because as the question asker has said, you make assumptions about that data in order to do that cleansing or that manipulation or whatever process, whatever kind of term you want to use. What is too much that it causes a problem? And I guess really the ultimate kind of high level answer is that from an auditor's perspective, we're interested, when we're thinking about financial statement audits, in whether whether the accounts are materially misstated. So is an amount of manipulation possible and fine that allows the data to be used in an analytic but doesn't mask any material risk? Again, something that's going to take a little bit more thinking, and I think it's something we'd be looking at guidance maybe on in the future. So if anyone's interested in that, please kind of reach out. But it's a very good question. There will always be an impact, and the question for us is, where is that line? Where is some manipulation okay because it aids in a sensible analytic, but where is too much kind of pushing it into a line where it's sort of, you know, smoothing out issues that might be there that actually could indicate a risk of material misstatement. Next question down. So some auditors use data analytics to perform risk assessment. Oh, sorry. One moment. There you go. Some auditors use data analytics to perform risk assessment and use the quantum of outliers to inform their risk assessment. Yep. Should the others also analyze that like the same way that they would if it was a substantive test? A great question. So this piece of guidance is focused very specifically on substantive analytical procedures. So it wasn't addressing auditors using risk assessment procedures for a couple of reasons, actually. The first was people were much more comfortable with using analytics for risk risk assessment, partly because the exceptions are in a way is what tells you that there's a problem. So should auditors analyze the outliers exceptions in the same way for risk assessment? They definitely could. And I think that initial refinement process is still valid from a risk assessment process. But really, I guess the bigger question there is something we talked about earlier, is I think for a risk assessment process, I'd probably stop earlier in the refinement process because I want to find where the problems are, and those issues might be different in a risk assessment process from a substantive one. So I think that is a really good question. We are actually thinking about some guidance around concurrent risk assessment and substantive evidence collection. So both ISA 315 internationally and in the UK, and there's some guidance in SAS 142 that talks about concurrent risk assessment and evidence collection, which is a really interesting topic, which I think we'll cover off some of that as well. So that's something we're going to think about. Fourth question was, all their interesting concepts, but I'm not in the UK. Have you been working with any other regulators, peers, to get this info into other jurisdictions? That's a very good question. Yes, we have. So the IAASB, who publish the international version, are working on a version of this guidance that I've been working on with them, which they're hoping to get out, I believe it's by the end of this year. So they're working on the same model, a very similar model to us, but they're thinking about it in an international aspect. I've also got some conversations coming up over the next few months with a few regulators in different jurisdictions. So chatting to the PCAOB in a few weeks. I'm going out to Hong Kong to talk to some regulators there as well. So it's a great question. And yes, we have. So both at the international level, and then also at some individual national kind of standard setter level. Excellent question. So final one I've got on the chat. How does one determine that data analytics is sufficient? So second bullet point in the slide in particular, what is a good way to determine if there are omitted variables in the DA box? 1 second, let me just go up. Are we talking about how does one determine that DA is sufficient? Second bullet point earlier slide. Are we talking about this one? If the author's understanding is sufficient, are recorded. Sorry, whoever asked that question, is it this that we're looking at? Just so I can make sure I'm asking addressing the right question. I don't know if anyone else has got any other questions while you're there as well. Oh, there you go. Yes, so the question was about this one. So if the auditor's understanding the entity environment are recorded and how balances relate, is it sufficient? I think that is a really good question. So how do you determine if your knowledge of the client is sufficient? And what's a good way to determine if you've missed anything out from that? I think it's one of the big ways of determining, I think, if your understanding is sufficient is what year audit is it? So one thing that we found very interesting is that in the first year of an audit, that bullet point, the second bullet point there, was way, way harder to determine if they've got a proper understanding or not, because they didn't have that kind of institutional experience recorded in the audit files. that allowed them to go, well, I understand how transactions are recorded. I understand the entity and its environment. So one of the big variables in determining whether or not you got everything or your understanding was sufficient to allow you to use these kind of analytics was how long have you been doing the audit for? Other things were how has the staffing changed? So we've definitely found a few times where there's been significant change in the staffing, even when things are recorded sensibly on the audit file. It can be very difficult to make sure that everything's factored in because, if you've got someone who's worked on an audit for 3 or 4 years, their ability to understand how the entity and its transactions are recorded work in a way that's sufficient to then do that sort of sophisticated analysis can be very, very interesting, because if that person's then not on the audit in subsequent years, one of the issues can be, well, that kind of institutional knowledge is lost a little bit. Another really interesting variable was management themselves. So how good, you would hope always, but not necessarily the case, how good are management at understanding their data flows? Have they just taken their data and they've stuck it in a platform and they don't ever worry about it? So it's kind of a bit of a black box to them. They know that something's happening with the data, but they don't really know exactly what. Or are they very involved in the process? Do they know where all their data flows and how the transactions work? Have management themselves changed? So there's all kinds of variables around setting and understanding those expectations. So that's a really good question. There's a lot of different kind of variables and potentials in there. I think that looks from there. Excellent. So that looks like all of the questions. So thank you very much for taking the time to come along today. As I mentioned before, pop on the FRC website. You can see this guidance under the staff guidance notes. My contact details there as well. So it's j.bradley@frc.org.uk. So if you're interested in this or talking about technology and its use in audit, please get in touch. But other than that, thank you very much, everyone.